Today, using ValueLine's digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, as mentioned, we have allotted time for questions and answers. Also, if you would like to revisit this presentation at a later date, it will be posted on ValueLine.com and our YouTube channel within the next 48 hours. To start, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As a jumping-off point for our stock search, let's start with an overview of the economic situation, as well as the ValueLine Research Department's view of the stock market. The following content was prepared by Harvey Katz, ValueLine's chief economist. Various factors are influencing market sentiment. When the focus has been on the healthy economy and the mostly upbeat second quarter earnings performance, stocks have rallied. Conversely, when the attention has turned to tariffs and trade and to other global headwinds, most recently the financial crisis in Turkey, equities generally have weakened. Going forward, we sense that the economy, geopolitics, the next earnings season, and the midterm elections, with their potential policy implications, will affect the ebb and flow of trading. Meanwhile, the economic underpinnings remain sound as the second half proceeds. To be sure, GDP is unlikely to move ahead with the same breakneck speed it did in the second quarter, when growth topped 4%. Slowing gains in employment, manufacturing, and industrial production, and a flattish factory utilization reading in July now suggest that GDP will rise by a still reassuring, but less imposing, 3% or so in the current 6 months. There are other things to consider. High-profile issues at present are the suddenly more hopeful trade wins out of China and the economic rifts with Iran and especially Turkey. Then there are the firestorms closer to home, where investigations and the midterm elections hold the potential to affect trading in the next couple of months. The focus will soon be on the Federal Reserve. To date, the bank has raised interest rates twice this year, and while inflation hasn't gathered much speed, there could be enough inherent strength in the economy to justify rate hikes in September and December. True, this prospective monetary tightening may be baked into the market already. However, should the economy press ahead with greater vigor than we now expect, a more aggressive rate stance could be adopted. For now, the bulls hold the edge, although as recent volatility suggests, their grip has become more tenuous than it was earlier during this historic market advance. In conclusion, the bull market may well preserve, but further notable gains could require time and effort. For now, as J.P. Morgan observed more than a century ago, the market will fluctuate. Personally, I think Harvey Katz's views are quite reasonable, and I'm going to use themes from his report in our search to find one stock to buy right now. For instance, he stated that notable gains could require time and effort, and that material fluctuations in the market are to be expected. Thankfully, ValueLine provides the tools and information to incorporate these factors into an investment strategy, which we will tackle in a few moments. For now, however, Please note that we are currently on our homepage, www.valueline.com. On this page, you can access, free of charge, daily market commentaries, as well as general interest articles that are written by our analysts. Examples of such content are analysis of the economic releases and quarterly earnings supplementary reports on the 30 components of the Dow Jones Industrial Average. Please be aware that earnings season just wrapped up, and if you want to review the quarterly results, as well as our takes on the stock's investment merits, you can access those from the View All featured link at the bottom. I am now going to sign in with my username and password. After entering my credentials, I am taken to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head to our home pages for our monthly stock selection services, such as Select and Dividend Income and Growth, as well as our investor tools, such as the Screener, Watch List, and Alerts. As you know, the point of this presentation is to find a stock to buy right now. So let's go to the Screener and get started. This tool can also be found via the Find Ideas tab at the top. Subscribers have access to more than a dozen preset screens and 50 fields. I should also note that the Screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. I'm now going to run a screen with the information we have discussed, as well as add some other worthwhile variables. The goal will be to find equities that are relatively safe, have a history of good financial results, and are expected to outperform the broader market over the near and long terms. Since Harvey Katz discussed at length that the ebb and flow and volatility of the market will likely persist, that is a good place to start. Personally, whenever I am conducting a stock search, I always prefer to remove risky equities, and there are numerous risk and volatility measures, but we recommend Value Line's proprietary safety ranks. The safety ranks measure the total risk of a stock and is arranged on an easy-to-understand 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. Thus, let's focus on stocks ranked 1 or 2. So I just click on the field and select the 2 numbers. These are financially sound companies, and their stocks have a history of relative stability. For those that don't know, our safety ranks are derived from our financial strength grades and our price stability scores. For more information here, I recommend a read of our ranking system guide, which can be accessed via the investment education section on our site, right up here. Now let's make sure that the stocks have a history of earnings gains, and I'm going to utilize the EPS growth 5-year field. This will weed out companies whose profits have been stagnating or advancing slowly, and even more important, unprofitable outputs. This will also remove newer companies that don't have a 5-year track record. Normally, I would set the lower percentage to around 8% or so. However, I want to solely focus on the fastest growing companies, so I'm going to set the rate at 12%, and then click Filter. Historical growth is helpful, but I also want to utilize Value Line's estimates and projections and pick stocks that are expected to continue to advance earnings over the next several years. This is a good time to mention that for all 1,700 stocks in the Value Line Investment Survey universe, we create 3 to 5 year financial projections. I want to highlight that Value Line is one of the very few research houses that provide financial projections that far out. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company. So let's include projected 3 to 5 year EPS growth. And again, I'm going to set the lower bound to 12%. Okay, 28 results. We're making some progress. Please note that Value Line's total database includes data on almost 6,000 stocks. With a few clicks, you can narrow it down to a couple dozen. Let's now focus specifically on the stock. As Harvey Katz mentioned, once again, notable gains may take time and effort. Thus, I want to isolate stocks that Value Line expects to outperform the broader market over the near and long terms. For the short term, I'm going to use our popular and time-tested timeliness ranks. Like safety, the ranks are from 1 to 5, with 1 being our top rank. 1s and 2s are expected to outperform the market over the next 6 to 12 months. 3s will likely mirror the market, while 4s and 5s may lag. A great deal of information on the ranking system for timeliness is available in our guide, but I should mention that although the calculation is purely quantitative and proprietary, the system is based on a number of factors, including earnings results and stock price action. So let's add the 1s and 2s to our screen. My last field will focus on potential stock price appreciation over the longer term. I already mentioned that Value Line's analysts create 3 to 5 year financial projections. Using these values, we then create a target price range for each equity. For the final field, I want to tap into this and include the projected 3 to 5 year annual total return percentage, and I'm going to focus on the low end of the range to be conservative. I'm going to use 8% as my starting point, which is approximately the historical average annual rate of return for the market going back decades. For this, I have to type in 0.08. Down to 6 results. And as you can see, the table shows all the fields that we entered. 6 results is nice and manageable. According to our criteria, these equities are relatively safe, have a history of healthy earnings gains, which are expected to persist, and according to Value Line, stand a good chance to outperform the market over the next 6 to 12 months, as well as 3 to 5 years. Several of these may well fit nicely in your portfolio, and I do want to call out Apple at this point, since the $1 trillion market cap company is certainly the elephant in the room. For those of you that don't know, Value Line has been recommending Apple for a long time. In fact, Value Line Select, our most focused equity service, which is designed to help investors build and manage a diversified portfolio of established company stocks, has been holding Apple since December 2012. At this time, there are many other stocks that hold our exclusive buy rating, and we are confident that market-beating returns are forthcoming. If this is something that intrigues you, please call 1-800-VALUE-LINE to subscribe or to check out a free sample. Okay, back to our search. After evaluating each before this presentation, I'm going to recommend Comcast Corp, ticker CMCSA, as today's one stock to buy right now. Before I go any further, I want to point out that screens can be saved and revisited by utilizing the button at the top. Let's now get some more information about Comcast. Clicking on the company name will take us to the equity's digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, and hidden so you can create your own customized stock report. Once I alter the presentation to my liking, I can save the changes from the sliding horizontal action bar. The next time I come to this report, it will look the way I set it up. I can also apply these changes to other equities. Most of you are probably familiar with Comcast, but I want to provide some details about the company's operation. This information is provided in the business description module. The Philadelphia headquartered corporation is a leading provider of cable TV with more than 22 million subscribers in 39 states. It also has nearly 26 million internet customers and 11.6 million phone subscribers. Lastly, it owns a number of TV stations, such as NBC, Bravo, and USA, movie studios, and sports teams and arenas. As a side note, the bulk of Comcast's business operations are within the United States. This may prove beneficial if trade and tariff concerns persist. Of course, even though the U.S. and China have tentatively agreed to talks, there is no guarantee that a trade war will be avoided. Moving on, how has Comcast stock performed of late? From the valuation module, I can quickly pull up a stock chart, and the yellow line is the stock's performance. As you can see, CMCSA hit a new high earlier this year, but has struggled since then. We will get to why in a moment. I now want to quickly highlight our classic one-page reports, which are available for all digital subscribers. They are available using the button here on the top right. As you can see, this report was from mid-June, and if you follow the financial news closely, you will know that Comcast has had a lot going on of late. When important information and or changes in our analysis occur in between our full updates, we publish supplementary reports. For Comcast, of course, we recently published a lengthy one, which I'm going to show you now. This will get everyone up to speed in regard to what is going on, and I will provide reasons why I'm recommending the stock today. Going back to the dashboard, the supplementary reports can be accessed via the quick links. Just yesterday, we put out this report, and as you can see, it includes not just Comcast, but 21st Century Fox and Disney. Per editorial analyst Nils Van Leeuw, in the first paragraph, Comcast posted much stronger than expected June quarter earnings, putting it on pace for record results in 2018. Still, good news on the earnings front has yet to translate into positive 2018 returns for the Philadelphia-based company and its investors. Indeed, CMCSA shares have sold off about 10% through the first 7.5 months of the year, even as the broader market, as measured by the S&P 500 index, has rallied 6% over the same time frame. The poor investment returns come amid growing signs that the cable industry's traditional cable bundle of 100-plus channels is in secular decline. Several company watchers have also expressed concerns that Comcast's planned acquisition of European satellite broadcaster SKY plc isn't a prudent use of capital, and that the proposed deal perhaps signals a dearth of attractive investment opportunities within the company's existing portfolio of businesses. What's more, we attribute some of the stock's underperformance to its attempted and failed bid for 21st Century Fox. In fact, a few weeks ago, Comcast bowed out of a bidding war for the entertainment assets of 21st Century Fox, conceding the win to the Walt Disney Company, whose latest $71 billion offer trumped the cable services provider's $64 billion counter to the House of Mouse's original $52.4 billion bid. That said, Comcast recently affirmed its commitment to bring Sky on board, even as the merits of the deal have been questioned by some, as the company faces competition for Sky. In fact, Disney's target, 21st Century Fox itself, is also engaged. Sky would give Comcast exposure to a European pay TV market that is generally less mature, while reducing its reliance on the U.S. All told, while some have questioned the benefits of buying Sky, we feel that it will bolster Comcast's market reach and profitability over the years ahead. In addition, the bullish long-term investment case for Comcast is grounded in no small measure on the company's ongoing ability to both better leverage existing franchises and to establish new ones. For example, in the 25 years since Steven Spielberg's 1993 adaptation of Michael Crichton's book Jurassic Park hit movie screens, Comcast's Universal Pictures unit has helped develop and market 4 sequels that has lifted the Dino franchise's global box office receipts to nearly $5 billion. What's more, Jurassic-themed thrill rides are now offered at 4 of Universal Studios' amusement parks around the globe. The company also continues to score big with Minions and the Fast and the Furious franchises. Another plus is Comcast's strong free cash flow, reflecting a cable communication subscriber base that still numbers more than 20 million, and which, for the most part, pays their cable bill month in and month out. That, combined with what's expected to be reduced capital intensity going forward, as customer premise equipment, for example, gives way to virtual gateways and bring your own devices, should give the company plenty of financial flexibility to, among other things, buy back shares and increase the dividend. All told, We recommend Comcast for both nimble and buy and hold investors, and it is Value Line's one stock to buy right now. Lastly, I want to mention that we will be putting out a new full report on Comcast in the Value Line Investment Survey in just a couple of weeks. This marks the end of our formal presentation, and I will now tackle your questions. All right, so give me a question. Give me a sec. There's several. I'm just going to go to the top and. Okay, first question is about my previous webinar, last month's webinar, where I recommended Red Robin, the burger chain. I mentioned in that webinar that a few days later they were going to report earnings. And while I wasn't expecting great results, unfortunately, they reported and the stock price went down a few percentage points. My goal was to provide that pick for a longer term, and I think you will still be rewarded for holding on to those shares. All right, next question. And in regard to Red Robin, I recommend keeping up with our updates in the Value Line Investment Survey. Next question, how accurate are Value Line's 3 to 5 year projected EPS growth rates? While we don't typically track individual metrics, we have tested the accuracy and validity of our 3 to 5 year target price ranges, which are, of course, based on earnings growth, and they've proven to be worthwhile. Of course, we don't get every one correct, and of course, there's tons of factors over that period that can affect our estimates, for instance, acquisitions or companies selling off their businesses, but they've proven to be quite helpful. There's actually been several articles written about the 3 to 5 year target price ranges and the Value Line median appreciation potential, or VLMAP. These articles have been written by outside observers, and I suggest a Google search, and they've proven to be quite helpful. What percentage of stocks ranked 1 for timeliness see a higher stock price over the next 12 months? It's an important thing to note that number 1 ranked stocks for timeliness doesn't necessarily mean we think the stock prices are going to go higher. We think they're going to be better than the relative market. So for that reason, we don't look at that percentage. For instance, in a down market, we think those stocks will fall less than the overall market. It's why we don't recommend short sellers follow the timeliness ranks. For instance, the 5s, we don't think are going to necessarily go down, just maybe increase less than the broader market over the 6 to 12 months. Next question. Hi, I already own Comcast, have owned it for 2 months. Does this recommendation mean that you should add to your position or just hold the shares you own? While I obviously can't provide personal investment advice, the name of the webinar is one stock to buy right now. So I am recommending the stock for today. Okay, where can I find definitions to the criteria in the screener? It's a good question. Within the investment education section, there is a glossary. All right, there's a few more questions. Next question, how do I get to the investment survey? There's a couple different ways. From the dashboard, you can see the weekly VLIS issue, as well as the summary index and selection and opinion. Those are the 3 main weekly publications that we put out as part of the Value Line Investment Survey. If you prefer the look and feel of our old website, you can use the traditional online access. And then from within Browse Research, you can also see all the stocks that are in your coverage universe. Analyst covered refers to the 1,700 in the Value Line Investment Survey, and the small and mid-cap featured is the more than 1,700 stocks in the small and mid-cap survey. And for those of you on this webinar that aren't current subscribers, we provide free access for our reports on the Dow 30. One person asked, can I see other seminars from the past? Yes. All of our webinars from the past, I think it's been about 18 months, can be accessed via our YouTube channel. So just go to YouTube and type in Value Line, and they're all there. In addition, as I said earlier, this webinar will be posted on our website and YouTube within the next 48 hours. Does the Value Line figure for cash flow equal free cash flow? Depending on what research house you look at, they have different definitions for cash flow. Ours is as follows. It's net profit plus depreciation, subtracting out preferred stock, divided by shares outstanding. And that's also something that's in the glossary for definitions of individual calculations. All right, next question. I want to buy something with an EPS growth rate the next 5 years, but with a small and mid cap. I'm assuming you mean stocks that we cover in the small and mid cap survey, although there are hundreds of small and mid cap stocks in the Value Line Investment Survey. But going back to the small and mid cap survey, and I know this is getting a little confusing, we unfortunately do not provide that level of detail for those stocks. We need an army of additional analysts. So the small and mid-cap survey does not have as detailed projections like the Value Line Investment Survey does. All right, there's a question about the challenge with Netflix. I apologize, I'm not clear on the question. Obviously, I don't know if it's a question just about the competition between streaming video providers, which, of course, there are many. We touched on it earlier with Disney's purchase of Time Warner, which owns HBO, among other properties. It's definitely a battleground with a lot of players that are going to be fiercely competitive for content and subscribers. I hope that answers your question. What's the price you recommend for a stop on Comcast? I'm assuming that means a stop loss. Honestly, I haven't really looked at that. I think most advisors probably say 10 to 20%, but that's really depending on your personal preferences and how long you're planning to hold the stock, or what your goals are. It's a little bit of an individual choice. Next question. By the way, thank you for all these questions. These are great. Is the upside potential less for a stock? Does it impact the timeless rank? Meaning, is it downgraded? There's a lot of factors that go into the timeless ranks. However, most of the information is historical in nature, meaning, earnings results, earnings momentum, price action, etc. So a downgrade to one of our, for instance, 3 to 5 year estimates may not impact the timeless ranks. Can you explain relative price strength and how it's calculated? Okay. Best way to do that is actually from the PDF. For those of you who don't know, the dotted line down here is the relative price strength. And all it shows you, and you don't need to look at, for instance, the X or Y axis. All it shows you is how the stock does versus our universe in those monthly time periods. There's 12 dots per year. So if the line from left to right is going up, that means that stock is outperforming the overall universe. And if it's decreasing, that means the stock is underperforming the overall universe. And just as you can see so far this year, with the exception of maybe the first month or two, Comcast has underperformed significantly. And we touched on that in the report. It's one of the reasons why I like the stock. It's underperformed. It no longer seems expensive. So I didn't want to pick a stock that looks completely overvalued. Isn't Comcast's secular decline still a problem? Yes, we talked about it in the presentation. Obviously, with more and more people cord cutting, but I think they'll have other ways of making that up and then some. You got to remember, even though people maybe get rid of the cable, but they still need internet and they still need phone. And Comcast, has a lot of other business lines as well. All right. How can I see the return after 5 years of the stock? The return after 5 years. I'm assuming that means historical performance. On our digital reports, you can see the total return of this stock versus some of its main competitors, as well as the overall investment survey. As you can see, Comcast has been good for the 5-year period, but has underperformed the broader market over the 3-year and, as we talked about earlier, the 1 year. The timeless ranks are for the market overall, our universe of 1,700 stocks. I apologize. There's a couple questions here that I'm reading that I don't understand. If I don't get to your question, or you want to ask me via email, you can do so. My email address is igendler@valueline.com. That's the letter I, GENDLER @valueline.com. Like I said, there's a few questions here that I'm not sure what they're asking, and I don't want to spend a lot of time trying to figure it out. Other people have things to do, including myself. All right, I'm going to pull up the PDF. Someone has a question about what appears to be, okay, in the capital structure box right here. First of all, long-term interest of $2.6 billion is the interest they're paying annually on their long-term debt. And then 48% of capital refers to their total percent of total capital, or long-term debt over long-term debt plus shareholders' equity. It's a good way to evaluate the financial flexibility of a company. If that number gets too high, it might hurt their financing ability if they need to borrow more. All right. Does the timeliness and safety rankings take into account the current market valuation of the company? Yes, the current, for the timeliness ranks, the current stock price and recent movements are included. The safety rank looks purely at the finances and the stability of the stock, or relative stability. So the current stock price itself isn't that valuable, but where it's gone, it is. How does Value Line account for the tax charge for many companies with repatriation? This could change the tax rate. Yes, as all of you probably know, the Tax Cuts and Jobs Act went into effect in December. As a result, tons of companies experienced tax gains or tax losses in the first quarter, and now they have the ability to repatriate money from overseas. In addition, the corporate tax rate went from 36% down to 21%. So over the last many months, we have changed, of course, our estimates for tax rates, and in just about every case, down significantly. And you can see that in our reports. Here's a good example on Comcast. As you can see, in the past, decade or so, they were paying in the mid-30s, and now we're expecting only 25%. All of our reports have been updated for the new tax legislation. Okay, can you clarify the dynamism of the ranking system? So sometimes a timeliness rank will move for a particular stock without any news related to that company, meaning they didn't report earnings or maybe the stock didn't move. But for instance, we only have 100 ranked 1 stocks at any given time. So if a current rank 2, something happened that made it push into the 1s, of course, a 1 has to drop out. So that's the dynamism. The stocks are actually ranked basically 1 to 1,700, with the top 100 being ranked 1. So there are shifts in relative position. If they don't get Sky, would this change Comcast's recommendation to a hold? I'd have to look into that more, and it depends, how long it drags out and what other companies get involved, or if there's a bidding war, or if Comcast turns their attention to another company. I think buying Sky will be a benefit, or would be a benefit. So I would be less high on the stock if they don't buy it and nothing else changes. Would Comcast timeliness rank go down because it doesn't buy Sky? It depends on if it impacts earnings and the price action. But remember, it's a purely quantitative result. It's a computer model, so I can't answer that definitively. Someone's talking about a UBS downgrade of Comcast, downgraded to 53 from 63. I didn't see that personally, but Comcast is priced at only $35. So if it got to 53 within a year, I'd be quite happy about that. All right, that looks like all the questions. Like I said, I gave you my email address if you want to send others to me. Thank you so much for joining me today.